Okay, so this is the What's the Big Idea event for our web listeners and web subscribers. We did an event this morning for all of our in-town clients and friends and others who had the opportunity to join us, and went really well, got some great feedback. We've been videotaping those events to post to our website the last few months, and the video quality is a little bit poor, so we decided to do a dedicated event just for our web subscribers, and hopefully we can get a little bit better content. So I'm going to be working through a slide deck that we have posted to the web. I'll be referencing some of the slides. If you want to follow along and look at these slides as we go, we'll share some of the data that we've been able to collect in the last month to help support our macro thesis, as well as the presentation on Brookfield Asset Management, which is this month's big idea. As many of you probably know, we do an event like this every month for our clients, and we try to pick an investment opportunity that we're executing on behalf of our own clients that's timely and well priced. So it's always worth your while to tune in. So on slide number 2 there is a little bit about Cush Capital and what we do and who we are. We are an advisory firm based in Overland Park, Kansas, and we market ourselves based on better research. That's really where our passion is, and what we enjoy doing is digging into the investment opportunities, and we host these events in hopes that we might be able to find more like-minded investors to engage in a conversation with, because we know when we can engage in a conversation about what's going on in the world and find other investors with our similar worldview, then we've found an opportunity to execute our strategy on behalf of those investors, and that's really an ideal situation for building trust. So at our core, we are a research firm. We practice golden rule investing, which is our marketing slogan to convey the fact that we have all of our own personal capital invested alongside of our clients. When we actually go to implement that, we have different risk tolerances and different buckets that we can put different clients in, but the riskiest portfolios that we manage are our own money, and then they get safer from there. We are very conservative in our approach. We're value investors at our core. We practice a biblically responsible approach, and we are certified Catholic practitioners, which doesn't make us the moral authority on anything, but it's our way of trying to more fully integrate what we do on Sundays with what we do during the rest of the week, simply trying to live a more holistic life of integrity there. So let me move on to this month's presentation, and this slide deck that I'm working my way through is very full. It represents the entirety of the data that we've captured to support our macro view, and at one point in time or another we've presented all of this data to our clients and others at this event. So I'm only going to touch on a few slides this month that are either new or especially poignant to our thesis, and the first of those is slide number 3 that details total U.S. debt outstanding. This is across all sectors: consumer, household, municipal, state, federal, business, and the notional value of that debt now exceeds $64 trillion, and when you put entitlements on top of that, we are well in excess of $100 trillion. So that number is too big for me or anybody else really to get their head around. So we share slide number 4 in this presentation, which simply extrapolates the path that we're on. And we call this slide the path to socialism. In the out years, the interest rate on our debt becomes over 50% of our total economy. So we're not alarmist. We recognize that this won't happen. This can't happen, but to change course involves some very difficult and painful decisions that have not yet been made. Our government has been doing a very successful job of kicking the can down the road through various money printing efforts by the Federal Reserve, but the austerity measures and the budget balancing maneuvers that we need have not yet been implemented. So we expect this to play out through a combination of tax increases, lower benefits, and increasingly what we see as a part of the solution is increased money supply that's going to allow us to pay off these debts with dollars of lesser and lesser value. And we're positioning our client portfolios to benefit from this type of environment. And the investment idea that we have to go through today, Brookfield Asset Management in particular, is one that owns a lot of hard assets and should do well in that environment. So let me flip forward to slide number 12. This is a chart that I found this month that details the price-to-earnings ratio for the S&P 500, calculated a couple of different ways. And a note on how we gather all this data: we literally consult hundreds of data sources on a daily, weekly, and monthly basis. We are continually reading and consulting with other thought leaders, and this data represents that data which we consider to be the most relevant and the most salient and some of the most impactful to share with our clients. And this slide in particular details the relative attractiveness of the market in terms of the expensiveness or cheapness of the market at any one point in time. And you can see here that the trailing price-to-earnings ratio of the S&P 500 in blue here is about 15 times. And that's give or take right around the historical average. What we prefer to look at is a method championed by Benjamin Graham, the godfather of value investing, who was Warren Buffett's mentor and taught it many, many years at Columbia Business School. He took the price-to-earnings ratio and calculated it a little bit differently. He took the same price in the numerator, but in the denominator he would use an average of the earnings over the last 10 years. And this metric cyclically smooths that earnings number and gives us a much more relevant number to look back in time at. And right now that number is at about 23 versus a long-term historical average of closer to 15. So that tells us that at this point in time, we don't want to be getting overly aggressive with our client monies in the stock market. The next chart I wanted to point out this month was slide number 13. Slide number 13 details U.S. corporate profit margins going back to the 1950s, currently at their highest mark in over 60 years, at just over 10% there. So since the Great Recession began in 2008, we've seen companies cut every ounce of fat they can out of their business model down to the muscle and the bone, and there's simply nothing else to cut. So as we move forward in this fledgling recovery, if you can call it that, companies are going to have to reinvest in sales and reinvest in R&D and reinvest in those other expense line items. And this naturally reverting business statistic, which is these U.S. corporate profit margins, will serve as a headwind for corporations going forward. Yet another reason that we expect our very conservative approach to outperform on a relative basis over the coming quarters. Now if you would turn to slide number 16. This is another new one we found this quarter, and it shows the S&P 500 index since 2008, overlaid on top of the periods of time in which the Federal Reserve had embarked on their various QE1, QE2, and Operation Twist money printing campaigns. So you can see here that the S&P 500 as a proxy for the economy here, a leading indicator of the economy, for one, is on life support. Without the heroic measures by the Federal Reserve, the S&P 500 index would be much lower than where it is today, and we expect those headwinds to continue when the Federal Reserve tries to remove that stimulus. Coincidentally, Operation Twist and the rally that we've seen since the lows of late September and early October, coincides with the LTRO, the European Central Bank's long-term refinancing obligation, whereby they have injected over $1 trillion worth of euros into the economy, into the global economy, and that has largely contributed to the rally that we've seen since late September. So I think that's all of my new charts. I'm just thumbing through this deck here, so let me draw your attention now to slide number 24 in our presentation, which is a pie chart of how we construct our client portfolios. And that's divided up amongst generals, which we consider to be your traditional buy and hold type securities. These are companies with what we call the 3 M's: great management teams, great moats, and the third M is mispricing. We've been able to buy them at an attractive price, and these are companies like Brookfield Asset Management, which I'll talk about today, that we have every willingness and ability to hold for not just 1 year or 3 years or 5 years, but potentially, all things going well, we could hold these companies for 10 years or more. We pair that traditional approach with special situation investing, options, hedges, and some shorts to create what we call a portfolio for all seasons. So slide number 25 details the 3 M's that I mentioned. These are management team, moat, and mispricing. Every investment opportunity that we put money into has to pass the 3 M's test. We look for a management team whose interests are aligned with those of our clients. So we like to see management teams that are highly invested. We like to see share buybacks. We like to see insider investing. We like to see a shareholder-friendly approach to managing a company. And then we also look for opportunities that have a moat. This concept harkens back to the Middle Ages. A castle's moat, the wider and deeper the moat, the more effective it was at fending off intruders. Well, in a business environment, the wider and deeper a company's moat, the more successful they will be at fending off competition, and thereby the more successful they will be at earning returns on invested capital in excess of their costs of capital for years and years at a time. So think superior brands like Coca-Cola, or natural monopolies like a regulated utility or a railroad, or other companies with extremely high barriers to entry. Brookfield Asset Management has a nice moat, which I'll get into. And then the third of the 3 M's is mispricing. It's easy to identify a great company with a great management team, but unless you have a great price, then your returns will ultimately suffer. So moving on to Brookfield, slide number 26 has some pictures with some of their assets on it. If you'll move through the next few slides quickly with me, I can give you an idea of what this company is and what they do. 27 details their portfolio. Brookfield Asset Management is an asset management company. They manage assets on behalf of their clients and collect a fee for managing those assets. In conjunction with that, they have their own capital, approximately $31 billion worth of internal capital that they deploy in conjunction with their clients. And we like to see that because it aligns Brookfield's incentives with their clients' incentives, and that's something we strive to do here at Cush Capital as well, so that's a very positive indicator. So their portfolio is divided amongst corporate real estate, infrastructure, power, wind farms, and some private equity and other investments. So they are generally vehicle agnostic. They have several vehicles that are publicly traded. They have several private LPs. They have several agreements with other large pension funds. They're in the business of managing assets. So wherever they see an attractive opportunity to pair their capital with somebody else's capital in pursuit of an asset, whether that might be transmission and distribution lines or timberland or a railroad, they'll pair that capital together and earn the fee for managing that assets. And then the legal entity that they choose to execute that strategy inside of is going to be the one that's most appropriate for their clients and most profitable for Brookfield Asset Management. So the corporate structure and the way all of these different vehicles come together can be a little bit complicated, but at its core, Brookfield is an asset management business. That's their core skill set, and management is doing exactly what you would expect them to do, which is leveraging that skill set across as many different opportunities to deploy that skill set as they possibly can. So the next slides 28, 29, 30, 31, and 32, 33, just kind of give you a general overview of what Brookfield is invested in. I mentioned property, $83 billion worth of their $150 portfolios in property, 18 in renewable power, 19 in infrastructure, 25 in private equity, and 7 in other. Slide 35 gives you an idea of their geographical diversification. They're in geographic areas that are stable and allow Brookfield to produce a very stable cash flows with a very high degree of certainty. Slide number 36 details Brookfield's $31 billion capital position, or their principal's capital. So I mentioned that they're an asset management company. They manage a portfolio of $150 billion. $31 billion of that is their own. Approximately $50 billion of that is their client monies. And then the rest is debt that they've taken on to finance these various opportunities. So this pie chart details only their capital, divided amongst power, property, infrastructure, private equity, and other. Slide 37 is about their management team. This is what initially attracted us to Brookfield Asset Management. Of note is the fact that we have followed this company for many, many years. So we owned it in 2009 initially, and did very well with our holdings. It was one of those things where I think we bought at 18 and sold at 28, and the valuation had just gotten a little bit ahead of itself. So it's our job as professional portfolio managers to know what a company's worth, and when a company naturally appreciates to its intrinsic value, then we will sell that holding and reallocate into something else. I mentioned at the start of this presentation that Brookfield's a general, and generals have always have the possibility to hold for a period of 3, 5, 10 years. But should the market get a little bit euphoric and we see valuations get a little bit ahead of themselves, even in the case of a general, it's our responsibility to sell and reallocate into more attractive opportunities. The nice part about having done all the work on Brookfield is that when its underlying intrinsic value catches up with the price, we can pull the trigger very quickly on a stock like Brookfield because we've done all the work in the past. So the management team is led by Bruce Flatt. We've heard Bruce referred to as Canada's Warren Buffett. He has a prolific track record of investing in this space. We feel very comfortable pairing our capital with him. He's very courageous. This next data point reminds me of the old Buffett quote about investing when there's blood on the streets, and he certainly did that after 9/11 when he was willing to put client capital to work in the New York real estate market, and that has paid off very well for him. His shareholder letters are amongst the absolute best. They are must-read for us here at Cush Capital. We really like that Bruce and the rest of the management team own 19% of the common stock outstanding. This is one of those data points that we look for as an indicator of a management team whose incentives are aligned with our own, and 19% tells us that. Generally speaking, they pair a 20 to 40% equity position of their own capital. They invest that alongside their clients' capital in the private funds that they manage. And then at the bottom of slide 37 here, I have a graphic showing the common share price performance of Brookfield Asset Management over the past 20, 10, 5, and 3 years. And I would just direct your attention to that 5-year number being 1%. That's really what creates the opportunity in this market. It's been 5 years where the share prices hasn't really moved over that 5-year period, and that creates the opportunity to invest in Brookfield and take advantage of that mispricing. So slide 38 is another slide detailing half a dozen or so different accolades that have been accrued by the management team over the last 4 or 5 years. Some very prestigious awards that they've been able to win for managing assets in this infrastructure space, which is a very small group of asset management companies that actually have the expertise to do this on the scale that Brookfield has the expertise to do this. So slide number 39 is all about moat. Brookfield has a very unique moat. For one, these assets are irreplaceable type assets that create a quasi-monopoly. Think office towers in London and New York, hydroelectric power stations in Brazil, timberlands in the Pacific Northwest. You simply can't duplicate these assets, and they provide Brookfield with a very stable cash flows that are based on long-term contracts, many of which have inflation escalators built in. We love the certainty of the cash flows for Brookfield, or that portion of their business. Brookfield's size, reputation, balance sheet strength, patience, conservatism, and overall reputation all strengthen their moat. So Brookfield has done what you must do in the business of asset management, and that is build a reputation and build a track record. Nobody's going to invest with you until you have a track record, and once you have that track record, it serves as a barrier to entry to hold your competition at bay, especially in an industry, in a field like infrastructure investments, where the expertise of really the expertise of the asset management field in this industry is concentrated with a very, very select few. And that creates a moat for Brookfield Asset Management. And it also tends to lead to very sticky assets. And that's evidenced by the fact that their asset management business grew by 15% just last year. So slide number 40. This is the most exciting part about this investment opportunity. The net asset value of Brookfield Asset Management today is $41 a share, and it closed yesterday at $30.51, creating an opportunity, or an upside opportunity, of 34%. And this slide is relatively sparse, so we could create another deck of another 40 pages to detail the valuations behind every single asset that Brookfield owns. But the nice part about this opportunity is that we've been following it for 5 years. We literally have a file folder that's 4 inches thick on Brookfield and the investments that they've put inside of their portfolio in the last 5 years. And we've grown comfortable enough with the management team whereby when they say the net asset value of Brookfield is $41 a share, we don't have to do much digging to validate that on our end. Moreover, we also know that because Brookfield Asset Management is an asset management company, they get paid based on the value of the assets they manage. So they earn a 1.5% fee on all the assets they manage. So they have to know what they're worth. And what they're worth cannot be a subjective number. It has to be tied to some very concrete estimates of what these assets are worth. So, on an annual basis, Brookfield has to invite in third-party valuation firms to determine what these assets are worth. We like that because it takes all of the subjective assessment and fungibility or questioning out of what these assets are worth. So we know that we have a real and very sizable opportunity to take advantage of here on behalf of our clients. Last year, Brookfield Asset Management, a company trading at $30.51 per share, earned $5.33 in earnings, which is a very nice year. They have a 5.8% free cash flow yield, which is over 300 basis points above the 10-year Treasury right now. And that spread is at a historical wide margin. That is a very significant spread above U.S. Treasuries, especially for assets that will reprice in an inflationary environment, which is something that we are concerned about in trying to position our clients' portfolios to both profit from, and we're trying to position those portfolios to protect their wealth in that environment, especially their purchasing power. Slide number 41 is another representation of Brookfield's relative attractiveness in this environment. It details their price-to-book ratio over the last 8 years. And you can see from this chart that based on this price-to-book ratio, they are as attractively priced today as at any time in the last 8 years. Slide number 42 is our conclusion slide on Brookfield Asset Management. A few other points here that I think are very significant to the thesis. I already mentioned that these assets are inflation resistant. The growth inside this firm is partially being driven by high government debt yields around the world, and that's state, federal, municipal level as well. When governments get themselves in trouble, one of the levers that they traditionally reach for is the sale of municipal assets, water treatment facilities, bridges, tunnels, other infrastructure type assets. And we know governments are hurting, and that oftentimes leads to fire sale prices. And we trust an executive like Bruce Flatt and the management team at Brookfield Asset Management to be patient enough to wait for only the best opportunities that we think are going to be inevitable in this operating environment. So Brookfield Asset Management should reap the benefits of that. They target a return on equity of 15%. Last quarter they increased their dividend by 8%, which is significant. That's a very meaningful statistic because we know that management teams as a rule don't increase their dividend unless they are highly confident about the cash flows coming into the firm and their ability to subsequently service that dividend and pay that yield, because management teams know it sends a very negative signal to the market if they are ever to decrease that dividend. So they're very, very careful and cognizant about the financial position of the firm before they raise it. And then lastly, later this year we expect Brookfield to spin off their real estate assets into a separately managed and publicly traded vehicle. And we know from history and our own experience that spin-offs are a financial transaction that tend to generate a lot of value and opportunity for both the companies being spun off and the parent company. So that serves as a catalyst, if you will, to force the market's hand to realize the underlying and intrinsic value of $41 per share that is embedded in Brookfield. So all in all, we have a great opportunity to pair our clients' capital with a great management team, a business that offers a great moat, and assets that give our clients some inflationary protection and in a manner that's consistent with our high-level macro thinking. So we're very excited to own Brookfield Asset Management. Slide number 43 is just a wrap-up slide, a call to action. We present this at every month. Like I mentioned, these events are all about finding like-minded investors. So if you are one of these investors, if you think like we think, if you're worried about inflation, if you see some of these dislocations on the global macro basis, all of this debt, and you're worried how to position your assets to both protect and grow over time, then engage us in conversation. Find out how we're managing around some of these same issues in our client portfolios, how we're executing Brookfield and other investment opportunities. Engage us via email, engage us via phone call, engage us via the web. We want to get you involved, and we want to find other investors who think like we do. So help us spread the word. Our next What's the Big Idea event is May the 9th at 7:30 a.m. in our offices. We will record that too for the web. But if you're in town, come by, catch the event. We always serve breakfast, and we usually get a pretty good conversation going with investors who are in the audience afterwards, so that's always entertaining. And then lastly, I always make a note to mention that we host a monthly investors club. This is not sponsored by Cush Capital, but it is a very fun investors club, and if you have a real passion for investing, then connect with us and we'll get you involved. It's an excuse to get together on a monthly basis and eat some barbecue and roundtable some of these ideas with some other investors who are really, really savvy at what they do. And then I also wanted to mention real quick that we will take our annual trip to the Berkshire Hathaway shareholders meeting next month. So if any of our clients are interested in getting involved on that trip, let us know. We'll be happy to find you some shareholders passes, and that's always a very entertaining event. And if anybody else is out there that just friends of the firm that want to connect with us up in Omaha this year, let us know. We'll get together. We'll get you involved in our client event, and it should be a lot of fun. So thanks again, and I look forward to hearing from you soon.